Hey, good evening, ladies and gentlemen. I'm going to do something a little different because for, umpty years, I've been talking about buying options on Thursday, Friday, expiration week, since back to 205, and versus just buying options when they become attractive. And this is really incredible because we have, in the blog I send out on Sunday, I write and I recommend what I think we're going to do the following week. And here we are. We're looking at this enormous basing period. We've had a big correction, about 7%. We're now basing. We're now basing in front of the 200-day moving average. Okay, so here we are coming into Monday, the week. All right, and now look at this. Here we are. We're going to recommend we have end of quarter markup. We have end of month, end of quarter markups where portfolio managers who are underperforming are going to try and catch up. Now, in June, you can see this correction we had. This is an enormous correction in June. Okay, everyone is underperforming. Everyone's crapping in their pants, for lack of a better word. They're all in the market's down 6% from here. Everybody wants to catch up and get a little better. Okay, don't forget the hedge funds are marked month to month. Mutual funds are marked quarter to quarter. Here we are at the end of June quarter. Here we are testing the 200-day moving average. 200-day moving average. Now look at the oscillator. This is the magic. We got jammed. We got extremely oversold. We went to 62. Okay, we came down. We retested the low. We retested, and look where the oscillator is. We have 5 types of divergence in the trading Bible. Here is leading divergence. The oscillator is 53, halfway up the page, and the market's retesting the low. And then you see what happens. Okay, so we could have bought calls here. I said we're going higher. And what I want to show you the difference. Okay, what happens when you buy on breakouts, you buy the way I teach, and you trade options on Friday, Thursday, expiration week, and what your returns are versus buying early in the week. Now, what I'm going to do is I show you this gigantic move. I have never seen, that I can remember in the last umpty years, 5 straight up days like. Now, we were looking for a great week. I sent out a blog every Sunday saying get long for expiration week and get long because we're going to have a strong end of month markup. I have never seen a markup like this. I mean, this is from 1260, this is 80 points in 5 days. Now, obviously, buying on Monday would have been a spectacular idea, and I want to show you the difference. I want to show you how to make money consistently, how you do this. Now, I'm going to swing over to the 30-minute chart and show you exactly what we do. And I could have showed you this day by day, etc., etc. But what I'm going to show you now, normally on my chart I have lines across. Okay, see all these breakout points here? See, multi-week breakout, support, breakout, see we go up. Here, breakout, we break out of this range, we break. Very rarely, see, you could have made the same five times return on Friday. But what I'm showing you is for 5 days we made higher highs and higher lows. I mean, it was incredible. Okay, now see blue arrow breakouts. And if I put a line across here, 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 all of a sudden I have a very congested chart. Now you can see we were oversold coming in to the week, got jammed. This is turbo, show you don't even go near the short side. Get jammed. We come down, sign of strength, oscillator average pinned. Look at the oscillator average, pinned. Anytime in the trading Bible we have an oscillator average at 44.35 and we have the average pinned at 90. Don't forget, this is 90, this is 8. So we're looking at a situation, we buy it, sign of strength, and the market rallies. And we come down, almost not quite 60. This is how strong it is. The market is incredibly strong. Okay, now what I want to show you, if you bought the options, the 560, this should be a 560s. Okay, 565s. I can't remember. I typed it wrong. Calls on Monday at 550. We're right in the blog. The 565s closed were 30 Friday. So you bought them down here, coming into the week, and you held them the whole week. Now, granted, you could have shorted some here, you wouldn't have made money. You could have shorted some here, you would have made some money on it. Could have shorted some here, you'd have made a little money on a hedge. But basically, if you bought them at $5.50, now, the problem is, in the weekly expirations, you might have been able to buy 10, 20 options on Monday. Okay? You couldn't have bought 100, 200 of them because they don't trade. $5 options don't trade the expirations. Now you may have been buying something out of the money for $1 or $2, but you would have made a return, but it wouldn't have been as good as from 5 to 30. So this whole week you went long, higher highs, higher lows, and again, I haven't seen this kind of week in a long, long time. Okay, look at this. Jammed, shallow. Every retracement is shallow. You just know this is power. So you hung in there the whole week, made 5 times your money. Bought at 5.5, so it was worth 30 on the close. Okay, may not have traded 30, but it was worth 30 on the close. Now, let's see what happens if you buy on Friday. Now, I can show you the 5-minute chart. It really doesn't matter. I'm not set up to show you the 5-minute chart at the time. You could have made the same 5 times return from 10 o'clock Friday morning as the 590 calls went from 110 to 570. So you almost got the same return here buying them. Now, I didn't buy them. They opened at 20 cents. Okay, I didn't buy them. That was 25 times your money on Friday. I picked the calls after the breakout. Now, what I'm going to do is spend 5 seconds on the 30-minute chart. Here's this downtrend line. Okay, look at this massive downtrend line we had on the correction. We broke out Friday. See, right after the opening, we broke out. That's when I sent an email out saying, you have a couple of, whoops, I did the wrong chart, guys. Sorry about that. But anyway, what I did was I sent an email shortly after the market opened and the market broke out to the upside saying, you have 2 choices. You can buy the cheaper puts and then hedge long with the S&Ps, or they were around 70 cents. Okay, they went down to 30. If you bought the S&Ps on any dips, you made money. You made some nice returns. Or you could have bought the calls at $1. Well, they got down to $1.10. To me, that's close enough for government work. And then the market, look at this, just goes straight up the page. So anywhere along the line, so you bought it at, here, you bought it at $1.10, it went to 570. Okay, they opened at 20. Hey, it's your choice. I wasn't going to buy them on a dip, not knowing they were going to break out. But once they broke out, we can chase them. And it broke out, and they went the same 5-fold from Friday here, because the option's $1, here it's 5. So you have a situation where I'm just trying to show you, you can buy it down here. This, by the way, is an exceptional week. There is no way in God's creation you will ever see this, maybe once every 5 years, where the market just runs up the page because the extraordinary circumstances of a lousy month. June was a corrective month. May was a corrective month from the highs. Everybody was underperforming. Everybody was ducking for cover. And then because the market rallied and the advanced declines was 3 to 1 every single day, you knew the market was going higher. You were buying dips. So on Friday, when the options went to 20 cents, if you were brilliant enough to say, we're going up the page, you made 25 times your money. If you were just a normal guy, waited for the breakout to set up, and you bought the calls, you made 1 to 5 and change. I mean, nothing wrong with that stuff. I mean, you could see the power that was here. Look at the I mean, the oscillator, I was telling you, power, jam. It can't go any higher. And the corrections are very shallow, just powerful moves up. So this is what I want to show you. The net of it all is, you know, you can buy options anytime during the expiration week. And remember, every week is an expiration week. But what I want to show you is that the best returns, the best trades, and this is week after week after week, this is going back to October 2005. The ability to make multiples of your money every single week is there. So whether you bought them on Monday and made 5 times your money, you bought them on Friday and made 5 times your money, it doesn't matter. It's there every single week. And then you add in the hedging profits, which were very small this week, you still made an enormous amount of money. And that's really what I want to show in this video, is that the opportunity to make money is there every single week. You see it in my blog. I set these trades up ahead of time, and you understand what I'm doing. And take a shot. Just come in. Come into my trading range. Come into my trading room and hear me tell you, you can buy puts. There's nothing wrong with buying 30, 40 cent puts and going long S&Ps. It's open-ended on the upside. You can lose 30 cents, 40 cents on an option, but you make 5, 10 points on the S&Ps. That's $500. And you're risking 30 cents, you're making $500. Nothing wrong with that trade either. All right, guys. Thank you. Have a great time. I just really wanted to spend a little time showing you exactly how the game is played, whether it's from Monday to Friday, whether it's from Friday to Friday. It works. It's exceptionally opportunity to make dollars. Thank you all. Have a great day.